How to create automated trading strategies that work without overfitting. I'm Manil, also known as Ghostal Trades on Twitter, and I also run Unbiased Trading, an agency where we can backtest and automate your particular strategies. Now, number one is keeping it simple. Focus on simple strategies built around core strategy types. Simple systems are less prone to overfitting, easier to understand and maintain, and often perform better out of sample. Just don't confuse simple with easy to do. Now, there's actually a lot to unpack with this particular first point. I think number one is if you're wondering what strategy types are, primarily that's just all the common types such as mean reversion, trend following, arbitrage, etc. And then when we're mentioning overfitting, what overfitting is where you're fitting a strategy too much to historical data, where it doesn't work on general data or new data. So that would be like live market data or out of sample data, for example. I think when a lot of people hear this, they really just focus on, oh, okay, let me just do an EMA crossover. That could potentially be a strategy that could work on particular markets, especially if they're more inefficient markets, such as maybe crypto or newer markets, for example. However, simple doesn't just purely mean simple parameters, for example. Primarily, at least when I'm talking about it, I'm talking about the amount of parameters I'm using. So a simple strategy would be employing maybe 3 to 4 parameters, and a very complex strategy would be me employing 10 plus parameters and then adding in machine learning to try and predict future forecast of prices, for example. That's a heavily complex strategy, and most of the time, unless at the top levels and you have a team and you're managing hundreds of millions, billions, for example, then yes, 100% that can work. But for like more retail traders, from everyone, including myself, such as other people such as Ernest Chan, who is amazing in the systematic trading space and algorithmic space as well. Robert Caravere, another great systematic trader that also used to be an institutional trader. They've all really said the same thing about keeping strategy simple, and that's often what's worked best. And now from my own personal experience, every time in the earlier days where I tried to be, I guess, original with my ideas or be very complex with my ideas, they never worked on out of sample data or new data. But the more I stick to the core principles of strategy types and trying to create a portfolio of those strategy types, that's what's definitely worked best for me. Two is testing framework. Let's just quickly hear from Kevin Davey on what he thinks on this.
Well, if you're doing any kind of back testing, normally what most people do is they will test up until today and optimize and then take those parameters and start trading them. That would be optimization with it's all in sample, because by in sample, I mean they've made their decision based on optimized data. So that's the first one. But then there's some people who said, well, I'm going to test for 5 years, but then leave the last 2 years of history. I'm not going to optimize that. And I'm just going to apply those parameters to those 2 years and see how it did. That's an out of sample test. So you optimized on one set of data, but then you applied those parameters to another set of data.
So primarily what he just explained there was just out of sample testing. That was just in case if you've never personally heard that phrase before. I know if you're maybe more of a discretionary trader coming into systematic trading, that can be kind of a new phrase to hear. But what I'm talking about here around testing frameworks is you want a framework to be able to test those ideas that are coming in, whether it be through experience, through papers you're reading, from online blog mentions, whatever. You need to have a good testing framework, such as out of sample testing, such as parameter sensitivity, such as Monte Carlo simulations. You want to do walk forward optimization, all those sort of things, while also keeping the core kind of principles of like trying to keep a strategy simple, not adding tons and tons of parameters, things like that, for example. Also having like a large sample size, for example. But yeah, if you want more info on these, I do actually have a Monte Carlo video explaining Monte Carlo simulations. So feel free to check out that other video for a bit more ideas of some of those individual parts of the testing framework. Now, 3 is parameter selection. Each parameter should fight for its place in your strategy. Having excess parameters is the easiest way to overfit a strategy. The ones that stay should show statistical significance and serve a purpose, whether generating returns or controlling risk. I see this so many times when I either overview someone's backtesting or I review someone's strategy. They have 4 or 5 indicators and parameters that are doing primarily the same thing, whether it be trying to detect choppy market conditions or trying to detect momentum. They have so many doing the same thing, where fundamentally you could probably remove most of them, or you could just keep 2, for example, and it would serve the exact same performance. So that's really important to look at, and this is also what's useful about doing parameter sensitivity, where you see the performance based on the parameter value. So let's say you're doing an RSI strategy, right? And it's a mean reversion strategy and you're looking to short when it goes above 70 RSI. What you could test around there is, for example, let's say you've used a really weird number like 83 for your RSI high value, you could then test 82, 81, you could test 84, 85, and then keep on going over that region and see how the performance declines. Is it rapid spikes? Is it, a slow decline? Ideally, you're looking for a slow decline, showing that it's like there's an edge around a pinnacle point or an optimum, and then it's declining from there. And things like that. Having parameters that actually serve your purpose in a strategy is just an easier way to simplify a strategy, because so many of the times people just have so many excess parameters doing relatively the same thing, providing no either advantage, whether that's controlling risk or generating more returns. It just doesn't really make sense. And also, a key word here is where I say it should fight for its place. What I'm trying to say by that is that, let's say you add a parameter and it increases your profits by a percent or 2%, right? Depending on the market, a percent could maybe be significant if it's on different markets. But let's say a very volatile market, a percent is normally not worth adding a new parameter just for 1% extra return. If it was adding 10, 100, those sort of things, 100% makes sense. That should definitely be added to your relative performance, right? So that's what I'm trying to say by it should really fight for a place. It should be significant. 4 is types of diversification. Running multiple strategies reduces the risk of any single strat falling, while pairing uncorrelated approaches helps offset individual strategy risks. 3 easy ways to diversify is instruments, trading types, and time frame. Think of it as a portfolio, basically. So this is an image from the Holy Grail conned by Ray Dalio, and it's primarily just showing you the annual portfolio standard deviation and the number of assets in that portfolio. So this is talking about a portfolio of assets that's being traded, not necessarily strategies, but we do know it works with strategies because of Jim Simons and a couple of others that have done papers basically around the similar topics and also mentioned it on interviews and things like that. So as you can see here, you're just reducing your risk as you're adding in more numbers of assets, basically. This is why I was talking about earlier. It's very useful to stick with each strategy being a particular strategy type, because then when you add them into a portfolio, it blends so much better. I did a tweet about this recently saying that, like, at least from my experience, when you try and make a strategy fit to multiple strategy types, so let's say it's a trend following strategy, but you try and make it good as well with mean reversion, it normally never works on out of sample or new data, just because you're trying to add too much complexity to one particular strategy. I've just found more consistency in having different strategies that are separate, and then putting them in a portfolio themselves. Now, if you need a team of quant developers who can backtest and automate your strategies, feel free to visit the link in the description and you can book a call with me and see how we can help either backtest or automate your strategy. Now, number 5 is start small and scale. Over leveraging or deploying excessive capital too quickly is a common mistake. A strategy earns its allocation by being tried and tested, plus its performance. Even when times are good, over leveraging can destroy an account, as Ernest Chan mentions.
That it's actually usually happen during the end of a period of good times for a strategy. You saw the strategy perform very well for 6 months, and say, wow, this is like a work of genius. I'm the genius. And let's leverage 10 times if possible. Right? It can be done if you're in futures trading or options trading, whatever. Maybe not in stock. They don't let you leverage 10 times, but certainly possible in futures, right? And then that is when the thing will start falling apart. So a lot of times, risk management means that you should not take a very short time period of your recent success to define your risk. You should really look at the stress, how the strategy looked in a stressful period. How did it look during 2020? How did it look during 2008?
Now, number 6 is more data, the merrier. Renaissance technology famously leveraged terabytes of historical data. When creating strategies, prioritize clean and quality data as much as you can. The more samples and conditions you test over, generally the better this statistical significance. This is also such a really good point about cleaning data. So I get a lot of people either book a call with me or mention on Twitter that they're doing manual backtesting. It's very easy to, kind of give you this false confidence when you're manual backtesting, saying, oh, look, I'm looking through all the data, I'm making sure it's accurate, etc. But primarily, if you're doing a large sample, so let's say you're doing 500 plus samples manually, the chances that you have made errors in there is astronomically high. And that's just one of the kind of bigger cons of doing manual backtesting, for example. It's the same with, human execution. Let's say you have to execute 500 trades. I think most reasonable traders would say, I'm going to have X percentage of that 500 trades that I'm going to make a mistake on. It's not many traders that could execute 500 trades completely flawlessly. Whereas if you're doing with code, for example, that is going to be nearly flawless or almost flawless. It will definitely at least be below the human error count, basically. Now let's hear Jim Simons of what sort of data they collected.
We have a tremendous amount of it. tick by tick even. So maybe not everyone would bother doing tick by tick, but we do. So what was the question?
Just if you could just explain on the type of data that you would use in your analysis. So one thing is share price. What are the other type of things that goes into it?
Well, it's pretty much just the time series of the prices of the stocks. Or we also trade commodities. In fact, that's what we started. We first traded commodities. It was hard to get a good system for stocks, but finally we did, and that changed a lot because there are a lot more stocks than there are commodities. So, but I don't know what data people are collecting, but it's out there to the public. There's no reason you can't collect tick data or any. Tick data means every time a price changes, which is every maybe 10 seconds or something like that, or minutes. That's a tick, so you collect those.
Now, number 7 is slavishly use the models. While this doesn't apply to creating strategies, once you have deployed a strategy, constant tweaks every day or week will kill your strategy. You need to give it time and gather enough data to make a sound decision. It sounds a lot easier than it actually is. As consistently being just one of the tweets I can put out and people always love it, it feels bad reposting it, but it's just a reminder to myself as well that you need to stick to your strategies. While yes, there can be exceptions where you can, modify your strategy because some crazy event happened, for the most part, if you're trying to tweak your strategy on a daily basis because you're looking over daily performance or weekly performance and you're trying to optimize it to get every extra percentage that you can historically, it will most likely just kill your strategy in the long run. It will no longer work on out of sample data, and you're just too aggressively optimizing it. For me, I try and view it on a weekly basis and then potentially, change things on a monthly or multiple months basis on a quarterly basis, basically. So when you do deploy a strategy, have a set amount of risk that you're willing to lose on that strategy, and then just let it run its course and see how it goes. Obviously, you want to do your good testing framework so you actually have an expectation of how much risk could be exposed to by running that strategy, for example, by running a Monte Carlo simulation. But overall, at the end of the day, it does take time. You have to run a strategy for a good amount of time before you get enough samples where you can really, have a good decision on what you should do or change with that particular strategy, or potentially if you need to turn it off. Now, there is a caveat here, is that time is sort of relative to the amount of samples. So let's say you're running a really high frequency strategy and you're getting thousands of trades every single week, then yeah, potentially you could probably modify it quicker. But for most retail traders, I haven't seen many traders be operating a strategy that's taking thousands of trades per week. So you often want to be waiting around a month, a couple of months, maybe a quarter, to make those decisions to optimize.
If you're going to trade using models, you just slavishly use the models. You do whatever the hell it says, no matter how smart or dumb you might think it is at that moment. And that turned out to be a wonderful decision.
Now, if you found this type of content valuable, feel free to follow me on Twitter at GhostTalkTrades, or feel free to subscribe. Have a great rest of your day.